Let's bring in Jonathan Golub, Chief U.S. Equity Strategist at Credit Suisse. Jonathan, good to see you. Thanks so much for joining us.
Good to be here.
Let's get your reaction to today's market moves, first of all, and whether that was just a one-off or you think something legitimate and the start of something bigger following the Fed meeting this week.
Well, the market seems to be having a little bit of a hissy fit over the Fed announcement, and it seems to be playing out over several days, and it's probably more that than anything else. The yield curve is flattening, value is rotating out of favor, growth in favor, small caps out. So even more than the market being down, there appears to be a bit of a realignment. I think it's important, though, to put this into longer term context. The market was up 43% over the last year. Now it's up 40% over the last year. And so, while this matters and we care, it doesn't really fundamentally change the story of what's going on.
One other factor that I noticed you've been writing about is, of course, we've been so focused on monetary policy this week, is fiscal policy and the prospects of further significant, sizable government spending diminishing and whether that needs to be priced into the market a little bit.
Well, that's true. What you had this past year is a whole variety of measures, whether it was, over last year, people were getting money from the government if there were small businesses to keep them afloat. There were, supplemental income payments to individuals. If you're unemployed, you got money from the government. Many of those are going to be rolling off. So there is a natural downdraft on those. However, and it's really important, a lot of the money that was given to people was never spent because they couldn't go out and do the things they wanted to do. So people's bank accounts are flush, their credit card debt is down, and they're dying to go out. And especially over the next, 12 months, we're going to see the unemployment rate continue to collapse. There's going to be lots of opportunity for people to spend. So I don't think it's a problem that the government is going to be handing out less, but it is clearly something that we have our eye on and we're focused on.
So earlier in the show, Barbara Duran thought that we might be mid-stage of the cycle. But if you think consumers are still holding on to that extra cash or are flush with cash from other sources and ready to spend, then it seems like you think we're earlier on in this economic cycle and economic rebound.
Yeah, for somebody to say this is mid-cycle is just crazy. This quarter, we're going to have something like 13% GDP. The last time we had something like that was, in the early 1950s under the Marshall Plan. And that's this quarter. And then it takes a big plunge, and we only get 7% GDP in the second half, based on economists' expectations across the street. That means we're going from 6 or 7 times the run rate, the long-term average on GDP, to only 3 to 4 times. These numbers are extraordinary, and this does not happen in the middle part of the cycle. If you look at the unemployment rate, we're 6% or so now. By a year from now, will be something like 4.5%. You don't have a 6% unemployment rate early on, and not have it plunging. This is what happens early on in the cycle, and the supply chain disruptions and the lack of ability to get the things that we need. We're nowhere near mid-cycle. The real question, and the Fed addressed this head on, when do we get back to normal? And that's what the dot plots are telling you. Sometime between middle of next year and middle of 2023.
Shepard Smith here. Thanks for watching CNBC on YouTube.